All right. As leading economic indicators such as the yield curve and corporate earnings point to a further slowdown, our next guest remains cautious on high growth areas outperforming in the short term. We welcome in David Mazza, Roundhill Investments Chief Strategy Officer. So let's lead off on some of these investment themes that we've been seeing playing out. There's been a lot of rotation recently. What are you making of the latest market moves?
Yeah, no, thanks, Jared. And I think as you noted earlier with Julie, there is a disconnect between the short-term trading sentiment and what long-term investors are doing. And we're seeing that play out. So January, of course, saw a massive reversal of the names and areas and sectors that underperformed last year. And they had a great month. But really, the belief there was that we were going to see a Fed pivot. And the pivot I think we're seeing is that we're going to have rates longer for higher, or higher for longer, I should say, as opposed to actually any cuts, because the inflation data that we're seeing is far from transitory. And as it moves into the core parts of the economy, it gets stickier and harder for the Federal Reserve to move away from its interest rate hiking cycle.
So, hey, David, it's Julie. It's great to see you, by the way. It's been a while. When you're looking at these groups that we're talking about, what then do you think happens if we're not talking super short term, right, a month or two? If we're even talking through the course of the year, do you think some of those quote unquote older economy sectors are going to indeed outperform some of the growthier areas?
Yeah, so it's interesting. If we look at certain sectors, particularly energy, that, of course, had a gangbusters 2022, but that was on the heels of decades of underperforming. I actually was on this program in January 2020 and called Energy the Trade of the Decade. And it's always fraught to make a market call that long in the future. But the reason being was they were so out of favor, so undervalued. And other areas of the market, like communication services and tech, were so overvalued, even though that's where the earnings growth was, that it made a strong case for rotation. And in this market, especially as we have the pressure of higher interest rates, of that inverted yield curve, and now earnings growth not being particularly robust on the back of some economic uncertainty, it still makes the case that investors may want to focus on where can I get profits and earnings today, as opposed to out into the future. And that's really, I think, one of the big challenges that some of the disruptive growth names, and really tech as a whole, had. For many years, your Apples, your Microsofts, your Alphabets, that's where all the earnings were. You could count on them quarter after quarter, not just to deliver robust earnings, but to have upside surprises. And that's really all changed. And I think many strategists are pointing to the fact that their valuations haven't really collapsed to make it say, yep, earnings have bottomed out. Now it's time to get back in. In my opinion, until we actually see evidence that estimates are being revised higher, it's particularly in those high growth areas, it's really difficult, I think, for investors to be confident that we're going to see that long-term pivot back into those areas. And for the time being, people are going to be focused on near-term profitability.
Well, and let's talk about that a little bit more, because those companies that are able to return capital to shareholders, that have strong cash flows, that have strong balance sheets, that's a common theme that we've been talking to analysts and strategists this year that are recommending, because in this environment of rising rates, those that are doing well tend to be few and far between, as we're seeing with earnings season. Just wonder what your screens are for these types of companies.
So a few things that I like to look at, either for individual companies or sectors that may be representative of areas that have high profitability, is looking at strong free cash flow generation. And what does that mean? Simply, do companies have the capital through their operations that are able to fund them through times of uncertainty? So a lot of cash on balance sheets, prudent use of that cash tends to be something that we would want to look for in this environment. Another simply way of looking for that, does the company typically return cash to shareholders, either through growing their dividends, buyback programs, or what hasn't happened yet, but I believe we may find ourselves, are they putting capital to work in R&D and productive uses? I actually think investors for the time being are going to favor companies that are not overspending. And that was a big problem. When interest rates are incredibly low, companies are incentivized to spend. And in fact, CEOs and CFOs are rewarded to spend in those environments. And of course, that's all changed. So companies that are being prudent with their cash, being prudent with their dividend policies, are likely to remain in favor. And that's why the areas like healthcare, like energy, materials, to some extent industrials, that real economy that many banks are pointing toward have the potential to outperform, are emblematic of that area, as opposed to kind of hopes and dreams that that these earnings growth may come to fruition 5, 10, if not 20 years down the line.
Dave, I got to ask you about one of your products over at Roundhill, related on this point, right? Which is the Metaverse ETF, which when it came out, had a lot of interest, a lot of fanfare. But this is like a prime example of what you're talking about, right? And of course, the company that named itself after that, Meta, is the primest of prime examples, pouring a lot of money into this exploratory area, really, and then now having to cut back on it. Like, what's the future for an area like that right now? How should investors be thinking about it?
Yeah, no, thanks, Julie. This is a great point, because nearly every comment I made would be contradictory to saying, of course, any company associated with the metaverse, whether it is Meta, Roblox, or have the potential to outperform today, tomorrow, what have you, because the macroeconomic environment is more challenging for them. With that being said, there remains a case for long-term investors to say, hey, what does this hype cycle look like? Are we actually at a better place from a valuation standpoint if we want to start entering and nibbling at areas of high growth, of potential for disruption? I think we already saw with many thematic funds, themes in general last year, that kind of the cream has the potential to rise to the top. So I'm actually happy to see companies being prudent, even in the high growth space, right? Meta, famously came out now and said that they want to be more efficient with capital spending on the back of last year sort of not necessarily being as efficient. So I would say even in high growth areas, even in companies associated with the potential for massive disruption, AI, the metaverse, what have you, that we look for companies that have that cash flow, that have that prudent approach, and realizing this environment is challenging for them. It's not going to turn on a dime. But if the investments are made now, the potential for all of these dreams to come true, and that kind of mixed reality or virtual reality of earnings can come true, then that actually puts us in a better position. So even though I remain particularly cautious on high growth areas in the very short term, that actually makes me more excited and bullish about opportunities over the longer term.
All right, looking out beyond the end of the year, most likely for that one. Dave Mazza, great to catch up with you. Good to see you. Roundhill Investments Chief Strategy Officer, David Mazza.